Hey everyone, welcome back to Smart Money Path. If you're new here, make sure to like and subscribe so more people can also benefit from our channel. Today we're diving into the basics of stock charts. Whether you're a beginner just starting out or someone looking to improve their investing game, understanding stock charts is a critical skill. So let's get started. A stock chart gives you a visual representation of how a stock's price has changed over time. While it may seem intimidating at first, with a few key points in mind, you can easily read and interpret stock charts like a pro. Stock charts show you the price history of a stock. You can see if the price is going up or down. This helps you make smart choices about buying or selling. Charts help you see the big picture. They show you what other investors are doing. Are they buying or selling? Charts give you clues about where the stock might go next. This is important for making money in the stock market. There are different types of stock charts. Each type shows you the same information but in a different way. Let's look at three popular types: line charts, bar charts, and candlestick charts. Line charts are the simplest. They connect the closing prices of a stock over time. This creates a line that shows you the general direction of the stock price. Bar charts give you more information. Each bar shows you the opening, high, low, and closing prices for a specific period. The top of the bar is the high, and the bottom is the low. Candlestick charts are my favorite. They are similar to bar charts, but they use colors to show you if the stock closed higher or lower than it opened. A green candlestick means the stock closed higher, while a red candlestick means it closed lower. Line charts are great for getting a quick overview of the stock's performance over a period. They are easy to read and understand, making them perfect for beginners. Bar charts, on the other hand, provide a more detailed view. They help you see the range of prices within a specific period, which can be crucial for making informed trading decisions. Candlestick charts not only show price movements, but also reveal patterns that can indicate future price movements. The colors and shapes of the candles can help traders predict market trends. Understanding these charts is essential for anyone looking to invest in the stock market. Each type of chart has its own strengths and can provide valuable insights when used correctly. By mastering line, bar, and candlestick charts, you can make more informed decisions and improve your trading strategy. Time frames are important when you are looking at stock charts. They tell you how much time each data point on the chart represents. You can look at charts for different time frames like 1 day, 1 week, or even 1 year. A shorter time frame like 1 day will show you more detail about the stock's price movements. You can see every little up and down. A longer time frame like 1 year will give you a broader view of the stock's performance over time. The price axis is the vertical axis on a stock chart. It shows you the price of the stock at different points in time. The higher the line or bar on the chart, the higher the price of the stock was at that time. When you are reading a stock chart, you want to look for patterns in the price movements. Are there any clear trends? Is the stock moving up, down, or sideways? These patterns can give you clues about where the stock might go next. Volume, the echo of the market. Volume is the number of shares of a stock that are traded during a certain period. It is shown as a bar chart below the main price chart. Volume is important because it tells you how much interest there is in the stock. High volume means that a lot of people are buying and selling the stock. This usually happens when there is big news about the company or the overall market. Low volume means that there is not much interest in the stock. Riding the wave, identifying trends on stock charts. A trend is the general direction that a stock price is moving in. There are three main types of trends: uptrends, downtrends, and sideways trends. An uptrend is when the stock price is moving higher over time. A downtrend is when the stock price is moving lower. A sideways trend is when the stock price is not moving up or down in any clear direction. Identifying trends is important because it can help you decide when to buy or sell a stock. Moving averages, smoothing out the bumps. Moving averages are lines on a stock chart that show you the average price of the stock over a certain period. They are essential tools for traders and investors, helping them to make sense of the often chaotic price movements in the market. They are called moving averages because they are constantly recalculated as new price data becomes available. This dynamic nature allows them to provide a more accurate reflection of the stock's current trend. Moving averages can help you smooth out the noise in the market and identify trends more easily. By filtering out the short-term fluctuations, they reveal the underlying direction of the stock price. There are different types of moving averages, but the two most common are the simple moving average, or SMA, and the exponential moving average, or EMA. Each has its own unique way of calculating the average price. The SMA is simply the average price of the stock over a certain period. It is calculated by adding up the closing prices of the stock for a specific number of days and then dividing by that number of days, while the EMA gives more weight to recent prices. This makes the EMA more responsive to new information, allowing it to react more quickly to price changes compared to the SMA. Technical indicators, RSI and MACD. Technical indicators are calculations based on a stock's price and volume history. They can help you identify trends, overbought or oversold conditions, and potential price reversals. There are many different technical indicators, but two of the most popular are the Relative Strength Index, or RSI, and the Moving Average Convergence Divergence, or MACD. The RSI is a momentum indicator that measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the price of a stock. The MACD is a trend-following momentum indicator that shows the relationship between two moving averages of prices. Section 9. Putting it all together, a real-world example. Let's look at a real-world example of how to use stock charts to make trading decisions. Understanding how to read and interpret these charts can be a game-changer for your trading strategy. Say you are interested in buying stock in Tesla, ticker symbol TSLA. Tesla is a popular stock with a lot of volatility, making it an interesting case study. You can start by looking at a daily chart of TSLA to get a sense of the stock's recent price history. This will give you an overview of how the stock has been performing over a specific period. You can then use technical indicators like the RSI and MACD to identify potential buying or selling opportunities. These indicators help you understand the stock's momentum and potential future movements. For example, if the RSI is showing that TSLA is oversold and the MACD is generating a buy signal, it might be a good time to buy the stock. These signals can provide valuable insights into the stock's current condition. Of course, you should always do your own research before making any investment decisions. It's crucial to consider other factors such as market conditions, company news, and broader economic indicators. Remember, reading stock charts takes practice. The more you familiarize yourself with different patterns and indicators, the better you'll become at making informed decisions. Don't be afraid to experiment with different chart types, time frames, and indicators to find what works best for you. Each trader has their own style and preferences, so it's important to find what suits you best. The more you practice, the more comfortable you will become with using stock charts to make informed investment decisions. Over time, you'll develop a keen eye for spotting trends and making strategic moves in the market.